Hello, so to continue our lecture on acquisition of stocks, date of acquisition. So again, let me remind you with number one, we don't assume a fair value of the NCI if using a valuation technique, if a fair value was already provided on the problem. So we simply use the fair value already given in the problem. We check if that fair value is not lower with the proportionate or the guaranteed or the minimum share. Then that's it. We only assume if no fair value will be given on a problem. Okay? So we check the fair value if it will not be lower than the proportionate share to avoid a negative goodwill. Because in any business combination, the result is either a goodwill, which is the usual result, or gain on acquisition in unusual circumstances. So there is no such thing as negative goodwill, especially negative goodwill being attributable to non-controlling interest. So the non-controlling interest has only two choices. Either it has a share on a goodwill, if the goodwill is a full or total goodwill, or otherwise it has no share on the goodwill because the goodwill is a partial goodwill. That's it. Definitely, there will never be a situation wherein the NCI has a share on a negative goodwill. No situation at all. Next is the determination and allocation schedule. So once the NCI was recognized at fair value, then we are assured that the goodwill, if ever the goodwill is the result, is a total or a full goodwill. So the total or the full goodwill is attributable both to controlling and non-controlling. If the controlling interest is 80%, then the price paid as one of the items in the aggregate is the payment for the 80% ownership. Then if the controlling interest is 70 or 90 or 60%, the price paid is the payment for the 60%, the 90 or the 70%. Then therefore, there is a need to recognize again the NCI. So, in computing for the goodwill, assuming the goodwill is total or full, in computing for the amount of goodwill attributable to controlling and non-controlling, it is not as simple as 80 and 20% or 90 and 10% or 70 or 30%. Especially if number one, the price paid includes a control premium, and number two, the fair value is something which is given in the problem. Or if we assumed the fair value, again, the price paid includes a control premium. So therefore, there is a need to prepare a determination and allocation schedule dissecting the full goodwill between how much is controlling and non-controlling. So as you already observed in my in the solution that I prepared, we prepare a column for controlling, a column for non-controlling, then the aggregate amount. So for controlling, the price paid for the 80 or for the 90 or for the 70% controlling interest. Then on the other column is the recognized amount of the NCI, which is at fair value, since we are discussing a full goodwill. Then we divide the identifiable net assets at fair value between 80 and 20%, or 90 and 10%, or 75 and 25%. Then we get the difference between the price paid for the controlling interest and the 80 or the 90 or the 70% of the net assets identifiable at fair value. And also we get the difference of the fair value of the NCI and the 20 or the 30 or the 10% of the identifiable net assets at fair value. Then the resulting amount will be the goodwill attributable to controlling and the goodwill attributable to non-controlling. So, next is in computing for the identifiable net assets at fair value. For purposes of computing the goodwill or the gain for acquisition of stocks, We start with the stockholders' equity again of the acquired company, or the net asset book value. We add any assets, normally assets, no? In few situations, liabilities, but normally it is the asset that will be involved. So we add the assets only to the extent of the excess of fair value over book value. It is again the undervalued excess, like inventories, building, furniture, or land, having a fair value on the date of acquisition greater than the book value. Then we deduct overvalued excess if in case the book value is more than the fair value on the date of acquisition. So from net assets at book value to net assets at fair value. Okay, so let me check. Then let me remind you also with the working paper entries. Working paper entries are only to facilitate the preparation of consolidated FS. When you say working paper entries, they are in no way will affect what is in the books. Working paper is a tool, no, to facilitate the preparation of a consolidated FS. And with the assumption of cost method in the books of the acquirer, wherein the acquirer in its books will debit investment account and credit the cash, for example, or shares or bonds. And also on the date of acquisition, the acquirer will also debit in its books expenses for acquisition related costs, or the acquirer will credit will debit, no, equity accounts if in case it pertains to stock issuance costs. So those are in the books of the acquirer. But when you say working paper entries, as far as date of acquisition is concerned, there may be three, no? So no particular standard on this, but I suggest, based on our discussion, I will be providing three working paper entries on the date of acquisition. Number one is about to eliminate the stockholders' equity of the acquired company. In IFRS 3, it was mentioned that the stockholders' equity of any acquired company, whether the acquired company is a dissolved company or the acquired company is subsidiary, the stockholders' equity of any acquired company is eliminated. The only difference, if the acquired company is a dissolved company, the she will be eliminated in its books. While if the acquired company is a subsidiary, then the she of the acquired company, which is subsidiary, will only be eliminated through the working paper. By number one, debit the ordinary shares, debit the share premium, and debit the retained earnings on the date of acquisition of the acquired company, the subsidiary, in full amount. Whether the subsidiary is wholly or partially owned, we eliminate through the working paper the individual she accounts of the subsidiary in full amount. Then we credit investment account to the extent of the controlling interest. If the subsidiary is partially owned, we also credit NCI. So debit she 100%, credit investment account 80%, for example, and credit NCI 20%. Another working paper entry on the date of acquisition is to update the assets and liabilities, if any, of the acquired company to fair value. So we debit land, we debit merchandise inventory, we debit furniture, if those assets mentioned are as fair value more than the book value. So we debit the undervalued excess. Otherwise, if book is more than the fair, we credit the overvalued excess. So the offset of the undervalued debited and the overvalued credited, we either debit or credit investment account, and NCI or NCNAS, again 80 and 20%, 70 and 30%, so on and so forth. Then the third working paper entry on the date of acquisition is regarding the result of the business combination. We credit gain on acquisition or income, as we debit investment in S company only, because again, gain on acquisition or gain on bargain purchase will only be attributable to parent. While if we debit goodwill, which is a full goodwill, for example, we credit investment account and Encinas na not automatically 80 and 20%, we may refer to the determination and allocation schedule for the amount of goodwill, which is a full goodwill, for example, attributable to controlling and non-controlling. Otherwise, if the goodwill is partial, as we debit the goodwill, which is partial, we credit only investment account. The investment account, after the 3 working paper entries, in the consolidated FS, it will be 0. So from the books, which is the origin, through the working paper, the journey, to the consolidated FS, the destination. So the investment account will amount to 0 in the consolidated FS after the working paper entries. While the Encinas, which is not recognized in the books, in no way that it will be recognized in the books, but because of the working paper entries, it will be recognized in the consolidated FS. So let me check. I think that will be for now, no? For the date of acquisition. Our next video will be about subsequent acquisition. So, see you again.